I think there was a genuine desire for level adjustment in the level of interest rates. You know, the R star, U star have come lower. Inflation has been disappointing, and there are uncertainty on the horizon. So this is really an insurance cut. The Fed had, flagged that. That is what they delivered. It remains reasonable to expect another cut sometime during, the rest of this year, and the Fed landed that.
And yet, Simon, Geraldine makes the point that perhaps, yes, more reason to come so, but I'm worried about the effectiveness of it. We've had negative rates, negative bonds, negative high-yield bonds, negative sovereign, and where's the extra investment going from? Where's the inflation coming through? Are we looking back at the effectiveness of the policy tool enough?
Well, we're not going back and revisiting the central bank models and saying whether the historical relationship we have with very, at least on headline measures, a very tight labour market, signs of capacity constraints are not feeding through to inflation. I think I'm tending to give central banks slightly more sympathy. They've got an inflation target here. Core inflation in the US has run below 2% largely for most of the last 4 years. They start to lose credibility if they're not seen to respond to that. But I think you make a fair point, which it doesn't appear at the moment to be permeating through to push through the wage and inflation indicators that you would expect at this point in the cycle.
I want to take it back to Geraldine. Chairman Powell went at lengths to explain the move yesterday, and he pointed to 3 characteristics. One is the growth outlook. There's downside risk to growth. The other is subdued inflation. But then he also spoke a lot about global developments. Is this a new style of Fed where they're a lot more aware of what's happening outside the United States and taking their cue from that to make future interest rate decisions?
Yes, it would seem so. The Fed didn't used to be, so aware in the past, but at the same time, U.S. corporations are more and more open via their profits to the rest of the world. Global financial conditions are also very affected by that. So in a way, that feeds all into the Fed's model, and it makes a lot of sense, I would say.
Stabilising pricing, moderating long-term interest rates, maximising employment as well. Don't we need to add to that placating politicians? And let's be honest about it. The Fed was very happy standing pat, observing what is opaque data. GDP was fine, consumer spending's fine, business investment not so good as well. Employment looking pretty robust. There are very mixed sets of data out there, Geraldine, and indeed Simon as well. Wouldn't it be better just to wait and see rather than just panic when the president got all stroppy with you?
I would say it did make sense. There seemed that, maybe last year December hike was one too many, that, we are in an environment of aging population and the level of interest rate as PIMCO, new neutral is showing is lower than before, and this slowly has fed through their model. So as I said, it was just a level of adjustment to take into account the fact that the structure of the economy is a little bit different than it used to be. And from then on, I think some data dependence will be at work.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.